Hey, I'm Courtney Randleman with Berkshire Hathaway, and today I'm here with Andy Lentz from Prosperity Mortgage, interviewing her with your biggest home buying and lending questions. So the first one today is, some of you wanted to know what's the difference between a pre-approval and what's the difference between a pre-qualification.
Well, typically a pre-approval is going to take a little bit more information to give a better estimate of your buying ability. So a pre-approval will include a credit check and also will look at the information that the buyer would provide regarding their assets and their available income. And then we would do an initial underwrite review. With a pre-qualification, some lenders will just ask very basic questions and not run credit. So it really doesn't give as good of an estimate of what it is you would be able to buy. A pre-approval is generally preferred by sellers and most agents.
Yes, I would say definitely in today's market where we're in multiple offers, a pre-approval would hold up more and make your offer more marketable. So our next one is, how important is a credit score, and what's kind of a higher range and a lower range?
A credit score is important. It's always something to consider. It's part of what is considered when rate gets factored in. A rate can be determined both by your credit score, by your loan to value ratio, how much you're actually borrowing based on the purchase price. And so paying attention to your credit is a good thing. A low score, we have products that we can lend all the way up to about a 580 credit score.
Okay.
A higher score would be something, if you have a score above 800, that is exceptional. But generally speaking, you're going to find favorable rates, or the most favorable rates, if you're above about a 720 credit score. Anything in between 580 and 720, rates may fluctuate slightly based on where you are in that range.
Perfect. Sounds good. So another question a lot of people had are, how much closing costs do you need to expect to bring to the table? And also, how much of a down payment could you usually expect?
Well, closing costs, typically, there's a real straightforward way to estimate. Typically, you're looking at about 3% of the loan amount. It can differ based on that loan amount. So 3% of a $350,000 purchase is a little on the high side for closing. Okay, so 3% of a $100,000 loan amount may be slightly lower, but if you average about 3% to estimate for closing costs, you'll be in good shape. So that's a good start. And as far as down payment goes, that's going to depend on the product. There are products out there. FHA has a product where you can put down as low as 3.5%. Fannie Mae and Freddie Mac, this is actually a conventional loan product that you can put down as low as 3%.
Oh wow, that's great.
And then typically with a conventional loan, the lowest down payment that you'd be looking at is 5%. You would need 20% down if you want to avoid private mortgage insurance.
Great. Well, that's good. You're teaching me something today. So what good options for first-time home buyers are out there right now?
For most first-time home buyers, a low down payment option is what they're looking for. So an FHA loan would be a great option. FHA recently changed their rules to make their product more appealing. Their mortgage insurance rates are more competitive and right in line with conventional loan mortgage insurance rates. So FHA is great. That 3% home ready loan that I mentioned, that's a great option. And then, if a buyer has 5% down, a conventional loan is really going to get them a better product to move forward with in the future, because with that private mortgage insurance, they have the option of getting rid of it once they build up their equity.
Good to know. So, question, speaking of rates, what does lock in your rate mean, and when does that happen? Especially now that we've seen somewhat of a hike or tiny,
Rates they've gone up a little bit, and people are concerned. Right now, I mean, it's really still a great time to buy a house. I mean, rates are really pretty low. Typically, you're going to lock in a rate once you go under contract. And when you first get your application together and it gets initially disclosed, you'll lock your rate. You can wait. Usually, you want to have the rate locks are the pricing is best when you're in about a 30 to 45 day lock. Okay. There are extended rate locks available, but you have to pay an additional percentage to lock for a longer amount because it puts the lender in a greater risk.
Okay, makes sense. So, question that even I could probably use a little more clarification on. Well, thank you, Andy, so much for helping us today and answering a lot of questions. Private message me with any other questions you guys have, and maybe next month we can chat again.
Sounds awesome. You're very welcome. Take care.